This video discusses some of the uses of options. One of the uses we can find for an option is to modify the return pattern. So let's recall the efficient frontier with the riskless lending and borrowing allowed. If you remember, it's anywhere up and down this line. Okay, if we were at point B, we'd have 100% of our money invested in risky assets, and would be coming down the line more towards the risk-free rate by giving up some of our risky assets for riskless assets. Okay, so point B and point A are 2 points of comparison. So point B is 100% in risky assets. Point A, let's assume, is 50% in T-bills. Okay, so 50% of our risky assets have been substituted away for riskless assets. Now, these should be normal distributions. I can't really draw effectively on an iPad, so just assume that they're normal distributions. As you can see, if you're at point B, you'd have more of a variation, right? There's more risk, but there's also a higher expected value. This return is higher than this return here, okay? So we have a higher return, but also a higher risk. If we were at point A and we substituted away some of that risk for riskless assets, we'd squeeze our curve a little tighter. So if you see, this is wider, this is a little tighter, and it goes up. But we've lowered our expected return, but the shape of these curves have still remained normal. Okay, it goes all the way to negative infinity, all the way to positive infinity. B as well goes all the way to negative infinity, all the way to positive infinity. Okay, so the shape hasn't really changed. We've just changed the risk and return pattern by moving from fully riskless assets to some risky and some riskless. Now, what do options do to change that? They help modify this distribution now, so that things may work out how we expect them to do. Okay, we could design it in such a way that it's modified. We could design it to restrict ourselves to not going anywhere past a certain number. And so we'll see how we go about doing that. Let's use an example to guide us in that process. So let's say there's an index fund that's valued at $1,500. That index fund has an expected return of 10% and a standard deviation of 15%. Now, assume that the investor buys a put on that S&P with an exercise price of $1,550, okay, and the put costs $60. Now, let's look at these two situations that could happen. Once you've bought the put, everything is going along. The S&P could do two things, okay? The S&P could go up or the S&P could go down. Let's say the S&P ends up above 1550. Remember, you bought a put. A put makes a profit when that underlying asset drops. Okay, so if the S&P ends up above 1550, you're going to let that put option expire. You're not going to exercise it. So the put option expires. You've lost basically that $60, right? So your total return now is reduced by the amount that you paid on that put option. Okay, so the amount that you paid on that put option was $60. Okay, $60 divided by the true value of the fund. That was 1,500, and 60 divided by 1,500 is 0.04. 0.04 is 4%. So you've lost about 4% because of that. Okay, so you've given up 4% of a return. Now you expect a return that was 10% before is now going to be 6% because you've given up that 4% through the lost value of that option that cost $60. Now, if the S&P 500 ends up below 1550, this is a situation when the put makes a profit, right? When the value of the underlying asset drops, the put is exercised for whatever value it has. So, what then would be our value? Okay, the return then is going to be 1550 over 1500 minus 1. So this is the return using the indexes minus 1. Okay, minus the cost of the put. Okay, so we have 50. So just to keep in mind, the textbook has a little typo. They write 1500 over 1500, but it's supposed to be 1550. Okay, so it's 1550 minus over 1500 minus 1, minus the cost of the put we just calculated was 60 over 1500. So 60 over 1500 is here. 1550 over 1500 is 1.033 minus 1. Minus, we already know that this is 4%, 0.04. If you do that calculation, you're going to end up with minus 0.00667, which is the same thing as minus 0.67%. Okay, minus 0.67%. So buying the put now results in what? It results in us lowering our high returns. Okay, we've restricted our high returns, but we've now restricted our low returns to being cut off at this value, okay, at minus 0.67%. No matter what the stock price does, our lower bound is going to be the worst outcome we could have is minus 0.67%. So take a look at it in this plot. Okay, this was our original curve where we had an average of 10%. And remember, these curves are normal. They go all the way to infinity and minus infinity. Okay, now when we've moved away from once we've bought in the put, remember we've restricted our expected return. We've lost 4% of our expected return. Our expected return now is 6%, right? So we're centered around 6, but it isn't a normal distribution anymore because we've cut ourselves off at this boundary at minus 0.67%. No matter what happens, we've restricted our lowest return to minus 0.67%. So that's a way that we can change the shape of the distribution of the return using options. The other way we could use options is to bet on information. Okay, so if you have an idea about the volatility of the stock, if you have a preceding idea than the rest of the market, let's say the investor believes that the volatility of the stock will increase dramatically, okay, and other investors in the market have not caught on to that yet. They're yet to discover this increase in volatility. Betting on volatility or making transactions based on the volatility of an underlying asset is not really possible without an option-based strategy. Okay, so one can make bets on the volatility of a stock by purchasing an option. Okay, why is that possible? Because the value of the option is directly related to the underlying stock return volatility. If you go back to the Black-Scholes model, you'll see that underlying volatility coming into play in the formula, and so we can use the options to extract that gain based on the information we have about the volatility of the stock. So basically, the two big uses are we can change the distribution of the returns. We could bet on information using options.